Good morning, everyone. Welcome to today's webinar on general business conditions. I'm Haley Shenander of the Federal Reserve Bank of Minneapolis. Before I turn it over to our speaker today, I have a few housekeeping items. Slides for this presentation and a copy of the video link will be emailed to all registered attendees next week. Ron will be entertaining questions at the end of our presentation, so if you have a question, please type it in the chat box on Zoom. We'd also love to get your feedback at the end of this presentation as well, so please take a moment to fill out the brief 3-question survey that pops up in your Zoom window when you exit the webinar. I also want to note that the views expressed during this presentation are the presenters and not those of the Minneapolis Fed or the Federal Reserve System. So before we get into the survey results, I'm going to provide a little background on the General Business Survey. The General Business Survey is one of the largest regular surveys of businesses conducted among the 12 regional reserve banks. We're able to hear from so many businesses thanks to our partnerships with chambers, government agencies, and other business groups who send the survey to their contacts on our behalf. So, as always, huge thank you to all of our partners who help make this possible. Now, the survey we're discussing today was conducted between January 13th and February 7th. We got 568 responses from business owners across the region, including a higher share from Montana and North Dakota this time around. We continue to see good balance by both firm size and sector, but I just have to note that these responses come from a convenient sample of businesses and may not be representative of the larger business population. Because of this, the results of the survey should be seen as more of a snapshot of current conditions and interpreted carefully. So I do have some quick takeaways from the survey before we take a closer look into the data. Overall, what we saw was a continuation of a lot of the trends we've observed over the last few years. Revenue and profits were still net negative, and this is now true across firms regardless of size, whereas in the past, large firms usually were outperforming smaller firms in this area. Hiring pulled back more, and most that were still hiring, which was about half of respondents, they were usually hiring to replace turnover. However, many noted that there was improved labor availability and that they were getting a lot more applicants than prior years. We also saw wage pressures easing alongside this improvement. And there were some improvements with price increases as well. However, respondents did note that their top challenges were still high costs and interest rates. We also noticed a lot of comments about increased economic uncertainty at the moment, but we didn't have a specific question regarding this for the survey. Overall, despite some of these negatives, the sentiment for Outlook was solidly positive. And with that, I'm going to let Ron take it away to talk about revenue and profits some more.
Thanks, Haley. Before I get started, I actually want to give a few thank yous myself. First, I want to thank Haley. She really is the brains and the worker bee behind the survey. So thanks for all your work on this, Haley. Next, I'd really like to just thank everyone for joining us today. Life is busy, and to join us today, I think is important. This information is really critical to the Minneapolis Fed, but we also think it's important for businesses and the general public to know about this stuff. So thanks for taking the time to learn what we learned today. My second thank you again is to our many partners across the 6 states. Without them and their willingness to get this survey out to their members and other contacts, we wouldn't have this information. So again, with everything that's going on in businesses and organizational lives, the fact that people are willing to help us gather this information is really important. So thank you. And lastly, to those businesses that took the time out of their busy schedule to share a little bit of their business experience with us so that everyone gets a little bit smarter about current conditions. You know, it's tough to click yes to a survey. We get so many of them. And so we really appreciate those business leaders that are willing to do so. So on to some results. Unfortunately, what businesses told us is that it's kind of more of the same in a lot of ways, at least from a headline standpoint. Just real quickly on how we orient a lot of our charts here. So what you're going to see is similar charts as this that are kind of a degree chart. So red means bad, green means good or growth. So red is typically decline, green is growth or good, and the deeper the color, the more on the edge it is. Okay, and most of the charts we're also going to compare over time. Because we're really interested, as Haley mentioned, this is really a kind of a directional survey where we want to see where things are headed, and it's less we're less able to say exactly where we are, but we're really trying to get the direction. Okay, and what you can see here is that revenue remains weak. You know, there really hasn't been much change. If you look at it very closely, it looks like maybe there's some improvement. I would take that with a grain of salt. What I take away from this is that revenue trends over the last quarter compared to the year before, really unchanged over the last couple of surveys. In terms of profit margins, it's kind of the same story. It looks actually very close to what you see for revenue. So if you look at the very bottom, the January 2025 survey is that the profit struggles are continuing. That roughly 2 to 1 say that profits fell versus grew. And I think we were familiar with a lot of the sources. We know that inflation has been tough, and it was recently ticked up a bit. We also know that interest rates are high, and then with the chart before, we saw that revenue has been fairly weak. There are some caveats to this as well as the revenue chart, in the sense that lower profits doesn't mean that firms are unprofitable. We don't ask that question. That's a tougher question, and we're not sure that firms are willing to share necessarily that information. And we also have to acknowledge that there might be some negative bias selection. And it's hard to tease out, but we have seen in our surveys that when things get worse, more people are kind of willing to take surveys, because I think businesses want to hear, they're interested, that we're interested in learning about what they have to say. And so we think there might be some negative bias here, but it's really hard to tease out. In terms of the future expectations for both revenue and profits, what we see here is that there's some improvement. I would say that expectations are slightly better, but as this shows, we still see more red than green. So I wouldn't say that either revenue expectations or profit expectations are good necessarily. Again, we're seeing some improvement. If you look at the revenue expectations on the left, we see some improvement in those that are expecting to see some revenue growth, and a few a little bit less than what we've recently seen in terms of those expecting a decline. But again, it's still roughly about on par, a little bit net negative, and I wouldn't call that a great trend. In terms of profits, again, a little bit of net improvement over last year's survey, but still net negative and by a fairly large margin. So we ask firms to give us a little bit of firm information so we can kind of splice and dice and take a look at revenue and other trends according to different traits. So we ask firms to tell us what state they're located in. And here you can see that North Dakota really was the only state that showed us a growth response. So good for North Dakota. What I would note is that other states are reflecting this slow trend. And I think more importantly, while we got a lot, as Haley mentioned, we had a much better geographic balance in terms of our responses, but we still had a few that were under 50 responses. And as a result, because we don't have large samples, I would call a lot of state results pretty idiosyncratic. That's why we don't share a lot of state results. But our partners are interested in this kind of information. I think viewers are too. And so I wanted to share at least one chart that shows most respondents from most states are still kind of seeing the same general slowness. But again, I would interpret this chart very, very cautiously. In terms of results by sector, what we see is that the finance, insurance, and real estate sector, as well as healthcare, nonprofits, public sector, saw positive year-over-year revenue. In terms of the other side of the equation, those not seeing so much of a positive trend: education and childcare, transport, wholesale and retail trade, construction and manufacturing saw among sectors worse revenue performance year over year. Again, here I would say even more, because there are so many sectors that we ask about. I believe there are 12 or 13. The samples across all of these sectors are comparatively small. So again, take this with a grain of salt. In terms of revenues by size, this is one that I think has been really interesting to follow over the course of the last 4 or 5 years. So we ask firms to tell us how many FTEs, how many full-time equivalent employees they have, and this is an estimate. It's self-reported. And what we've seen, and this has actually been a fairly consistent share by firm size over time. So we really like to watch how this is moving. And what you see is that we're seeing very similar results by firm size. And that's actually been really unique of late in that if you go to the chart that's on the right hand, in the right hand corner, if you go back just 2 years, what we were seeing, especially as a lot of the pandemic effects were still kind of really embedded in the economy, we were seeing that large firms were having significantly better overall performance than small firms. And what we've seen is that, at least from a revenue standpoint, that has largely evaporated. Why exactly? There's probably a lot of reasons behind that, but we think it's useful to share that this is not an economy that seems to be necessarily favoring large firms over small firms, again, on some of these big measures, anyways. In terms of profits, here you see a little bit more differentiation by size. And what I would say is there's really kind of no clear pattern or no clear advantage actually related to specifically to size. So the 1 to 10 FTEs and the more than 250 FTEs, virtually identical in terms of their profit trends right now. And with that, I will hand it back to Haley.
Thanks, Ron. So let's take a look at what respondents told us about hiring and other labor concerns in January. This year, we can definitely see that hiring has continued to soften quite a bit. Here on this chart, we're comparing the prior 3 January surveys in blue and green to this year's results in red. We see that compared to 2023 and 2024, a much higher share were no longer looking for workers. And this is the first time since we started asking this question that half were no longer hiring. For those that are still hiring, most are hiring to replace turnover, but even that share has eroded since 2023, and a much smaller share was hiring new full-time workers. Good news is that despite the pullback on hiring, the share that are reducing their staff is still really small. So it seems like even though more businesses aren't actively posting jobs, many aren't willing to let go of their employees yet. We also see that many businesses expect their staffing to be flat in the near future, but expectations for future hiring were slightly net positive compared to last January. Now, as hiring has slowed down, we see that labor availability has continued to improve. The share reporting that finding and hiring workers was extremely difficult was at its lowest levels since we started asking this question. Part of this is likely because since there aren't as many businesses looking to hire, those that are looking are having an easier time doing so since there's just less competition for potential employees. However, it's a bit of a chicken and the egg situation here. Some businesses are no longer hiring because labor availability has actually improved for them. A few noted that they were getting a lot more applicants and that turnover has slowed down considerably, so they just didn't need to hire anymore. Now, this improvement in labor availability was reflected in responses to our question asking about challenges when hiring. We see in this chart that applicants without the right skills or experience have always been the main challenge, which has increased over the last year. However, the problem of not having enough applicants actually decreased quite a bit. This kind of shows that there might be a lot more people looking for jobs, but they just aren't quite the right fit for the jobs that are currently available. We also see that wage demands of applicants is increasingly less of a problem, indicating that workers just may not have as much bargaining power anymore. And now, if we look more closely at wages, we see that the pace of wage growth has slowed over the last year. More businesses in the comments were saying that large increases were just too difficult to afford right now, but that they would keep increasing at smaller levels to try to stay competitive. Additionally, we see that larger businesses tend to still be giving larger wage increases to their employees than smaller businesses, with one small caveat here. Interestingly, the largest employers with over 250 employees were increasing wages at a slower rate compared to more mid-sized firms. We saw this happen in last January's survey as well, and while it's hard for us to tease out what exactly is behind this lower wage growth, we thought it was an interesting result to highlight here. Now I'm going to pass it back to Ron to discuss some challenges businesses have been facing.
Thanks again, Haley. So we know that employers continue to face a lot of challenges in operating their businesses and, kind of sort of just when stability looks like it might be settling in really over the last 4 or 5 years, something changes. And right now, what employers are saying is that inflation, those bars to the far left, that really remains the top challenge. I don't think that's a great surprise. And it did actually see a small decline from last year. Interest rates and labor availability come in second and third. Those are the bars right next to that. And those are both trending lower. And as Haley mentioned, labor availability in particular is really trending a lot lower. However, there does seem to be some heightened concerns over other matters that kind of are hard to identify when this survey was being prepped in early January. So again, when we're trying to put this survey together to get it out to our partners, there's only so many things we can necessarily anticipate and what to put in here. Um, and what we've seen is that there seems to be a rising share of respondents that choose the far right category. And there were almost 150 open comments on this question. And it's difficult to tease out exactly what the hard findings are here, but there seem to be a few rough themes. One of them is that the earned sick and safe time law in Minnesota, which requires employers to provide paid leave to employees, and it went into effect this past year, was mentioned fairly frequently. As was the general heightened uncertainty over things like tariffs, immigration, and other recent federal policy actions or proposals. And the thing with this is that uncertainty is just very difficult for businesses to deal with. Employers can, and we've seen them repeatedly adapt to almost anything that they can actually plan for. But I think there is a little bit more difficulty, a little bit more challenge right now because there is a bit more uncertainty in the environment right now about a range of factors that might or might not affect businesses. And so again, we don't know exactly how to interpret, that uncertainty context, but we think it's important to point out. And as I mentioned, inflation is one of those things that really affect businesses. And what we're seeing here is some good news. That would be that generally that we're seeing the same general trend of easing price pressures at both the wholesale and the retail level. Again, this doesn't mean that inflation has been tamed, doesn't mean that businesses are not facing inflationary pressures, but we are seeing those pressures recede at both the wholesale level and in those final prices to customers right now. We also asked about the impact of current interest rates on businesses. And, again, I think we very much understand that interest rates are high and they're problematic. But if you look at the very far left set of bars, the significant negative impact, it does look like we are seeing a little bit less of a significant negative impact, probably because firms have had more time to adjust, more time to game plan about what you do if you need if you need to borrow capital. We did also, I kind of looked at this survey or this question, excuse me, related to firm size. And actually the impact here is actually slightly a little bit more negative for those among large firms. So again, it's not dramatic, but I was kind of anticipating that maybe small firms were having more difficulty. At least among our survey respondents, it was actually larger firms that were seeing a slightly more negative impact from interest rates. We are also seeing that a small but slowly growing share, about 8% this survey, are actually seeing a positive impact from rate hikes or from high interest rates. And that's likely because there's something having to do with a better returns on company savings. And with that, I'll pass it back again to Haley.
Great, thanks, Ron. Finally, let's take a look at what respondents told us about their outlook for the next 6 months. Despite these challenges with high costs, businesses were solidly net positive with their outlook. Quite a few businesses did mention that while they are positive at the moment about their outlook, there has been a lot of uncertainty lately about what will happen to the economy, so they're nervous about what's to come. However, others felt pretty well positioned to face any future challenges if they arise. So, overall, just to recap what we went through, we have seen that revenue and profits are still being impacted, with respondents often pointing to high costs and falling demand. Labor demand has also pulled back, but half are still hiring in some way. Wholesale and retail price increases eased despite the reported challenges with high costs, and we saw that labor availability improved and wage pressures eased for respondents. With these improvements, outlook was solidly positive overall, but there is some concern about how changes to current conditions might impact businesses going forward. So with that, before we jump into Q&A, I want to share some information about another survey we conduct. In addition to this survey, which is twice a year, we also survey businesses on a monthly basis through our Business Pulse survey. We are always looking for new business owners or key financial decision makers of firms to sign up to become a respondent for the survey. So if you would like to help inform the Fed and share how current conditions are impacting your business, please scan the QR code on your screen or use the link in the chat to sign up. So we do have some time for questions. If you have a question, please type them in the chat box on Zoom. And let's see, how about we start with this one? What sectors are currently doing well and which ones poorly? And do they align with survey results?
If you look at GDP figures for the last 12 months, and that would not be, especially at the state level, that wouldn't necessarily that would only get us through the third quarter. But what I would say is they generally match in Minnesota particular. What you do see is that the certain areas like from a GDP standpoint, healthcare in particular has been doing quite well. That matches with our survey findings. There are a couple that don't necessarily match up. Construction, actually, from a GDP standpoint, has been doing okay, and that I think might be related to the fact that we are building a fair amount, especially nationwide and even in Minnesota, a lot of data centers. I don't necessarily know that our construction contacts are saying the same thing unless you might be in that sector. And in terms of some of the downside, what the one that really stands out right now is farming. The farm income or the farm economy is not doing well because of commodity prices, and it's hard for me to know exactly how this fits our survey because we don't get a lot of respondents, particularly in that sector. So my answer would be that it kind of matches on a rough scale, but there are definitely some differences between the two.
Great. Thanks, Ron. Someone else asked, the survey suggests that price pressures at the wholesale and retail level have gotten better over the last year, but recent data suggests that inflation has ticked up slightly. How do you square those two things?
Sure. Thanks for that question. That's a really interesting question. I would say there's probably two factors here, and it probably has to do with both kind of detail and with time frame. So as we've mentioned a couple of times, our survey is really not designed for really exact detail. It's generally looking for overall direction and pressure. And here we find that price pressures over the last year have receded. I think our charts are pretty clear on that. Um, and we see that that's been the case in the data again over the last year in general. But I think timing and frequency is kind of that other factor. We've seen a hiccup in prices and in CPI recently. Um, and if we had been surveying more frequently, comes out twice a year. If we had been surveying the last several months, we might have picked up on more of that recent uptick in pricing. And in fact, our monthly pulse survey has picked up on that. I don't happen to have that chart in front of me, but people can go online to our website and look at our regional economic indicators. That survey is on there, and it has actually picked up on that little bit of price increase of late. And I don't know, I should be paying attention to the chat box. I haven't. I'm hoping there might be a link to our website where you can look at that business pulse survey results that kind of do show that our survey work is picking up on some of that hiccup in the inflation trend right now.
Someone from Montana asked, when it comes to the workforce or lack thereof in Montana, we still hear available and attainable housing and childcare costs are the biggest challenges in recruiting new talent. Do you see that across the board?
So our survey wouldn't have picked up on that, but we hear that very, very regularly. So aside from our survey work, well, and I would even actually say in our survey work, a lot of comments, we get a treasure trove of comments. And what I would say is those things are mentioned, maybe not regularly, but I definitely see those in our survey comments. And when we are also out on the road, when we're giving speeches, when we are doing roundtables with business groups, that is absolutely two of the things that we hear very, very regularly: the availability of housing, because if you're going to try to attract employees, you have to find housing for them to be able to move into. We know that housing is very tight across the country. I think in Montana, maybe nowhere more so than in Montana in terms of the ninth district. And childcare also is a really big key for attracting more workers, not only to an area, but into the labor force. And we know that, for example, in Minnesota, the actual number of the capacity or the supply of seats for for children of various ages is actually contracted a little bit. And what we would want is something is that to get bigger, but we have not seen that. So I think it's something that communities, businesses are really kind of trying to they're scratching their head and trying to come up with some solutions to that, but they are very, very difficult issues. In terms of housing, it's a difficult issue because again, financing is more expensive than we would maybe like it to be, but there are reasons why interest rates are where they are. But we're hoping that maybe the economy can get on better footing, where maybe some rate changes would help the housing supply going forward.
Kind of in the worker topic here, someone was wondering if businesses aren't laying off employees, are they doing anything else to alleviate labor costs?
Well, we have been hearing a few comments. There's always been automation, and so I don't know that I've seen any significant uptick in automation or in technology investments, especially as labor availability has gotten better. What we are seeing is a few comments here and there about the introduction of AI into some businesses. I think that's something that we'll be following kind of going forward. And as I think you mentioned, or if you didn't, I think we are also seeing businesses, because they work so hard to get their labor force, even if things are slow, they are doing very often kind of different things to try to hold on to those employees. We had one manufacturer tell us that they are cutting hours, but keeping everybody employed, but cutting everybody's hours in order to try to get through to what they expect to be a busier time in the spring. So businesses have really for forever have always been having to deal with kind of labor issues. Over the last 4 or 5 years, it's been particularly tough. I think it's gotten a little bit easier for some, not good necessarily, but we still do see businesses really try lots of different strategies to try to right size their labor force.
One person asked, what concerns did businesses have about potential tariffs?
Sh Right now, I think it's, for many businesses, is kind of a wait and see because, a lot of the tariff talk right now has been, I don't wanna say on again, off again, but there hasn't been kind of, a position that businesses know is going to hold, and so I think that adds this a little bit of the uncertainty. In terms of tariffs, I think the economics is pretty clear on this. If it's a one-time tariff, then that's going to be a one-time inflationary effect. If it becomes kind of tit for tat and reciprocal and ongoing reciprocal, we don't really know exactly what that's going to mean, but we know that that is likely to be more inflationary than not.
And it looks like we have time for one more question. So someone was wondering, what sector slash industry could you use more respondents in?
All of them.
Yeah.
For really, that I don't mean that jokingly in the sense that with all sectors, the more we get, like I would say, we get a pretty good response from construction, manufacturing, banking. Um, Most of the others, I think we could use more in, because in some cases we're getting maybe 10, 15, 20. So if you are a business out there, or you happen to be the executive director of a trade association or any kind of industry association that you think you might be interested in getting involved in this survey, please reach out to us. Again, we know that surveys are a tough thing. People don't want to take more surveys, but I'm hoping that, by the end of this, people kind of hopefully realize a little bit more that what we're trying to do is really give information to everybody. This is really a two-way survey in that this is not just for our edification and our benefit. This is for everyone's benefit. So if you have any ability to help us find more business responses, business respondents, that's going to help everybody.
Well, great. That is our last question for today. And thank you all so much for joining us. More information will be in our follow-up email to this event. And with that, I hope everyone has a really great day.
Thank you, everyone.